Well, it seems we have a new phenomenon in the stock market and in this bubble. It's called Who's the Dumb Money? Well, it used to be shoe shine boys in 1929 when Kennedy stopped buying stocks and, made his fortune buying them at the bottom. I remember in the tech bubble in late 99, early 2000, I was traveling so much, taxi drivers were telling me what to buy. Well, we showed in the March boom and bust back in 2018 how in this whole rally since 2009 that's been built on quantitative easing and not strong fundamental trends and not strong productivity and all the things that drove the 90s bubble in tech stocks and the roaring 20s and things like that. The net only sector of buyers of stocks that have been consistently buying and have been dominating buying net of buying and selling has been corporations buying their own stocks. That is the new dimension in this bubble on top of quantitative easing. But because quantitative easing has brought interest rates so low that corporations can borrow cheaply and buy back their stocks to accelerate their earnings per share. Less stocks outstanding means the earnings per share go up much faster than earnings. So this is the game being played, supported by central bank policies. And again, the central banks just wanted to save the banking system in 2008 and 9 with all this stimulus and prop it up, but you get all of these side effects. And again, this is big. Now, institutional investors have not been net adding to stock investing. Private retail investors have been adding a little bit, especially recently, and foreign investors have had a bias of buying U.S. stocks net positive. But again, dominated by corporations buying back their own stocks. Now think about this for a moment. If companies continue to buy stocks at these high valuations at the top of a bubble, to accelerate their earnings per share and their, stock grants and option incentives and things that make the executives rich. And then their shareholders see the stock market crash 78, 90% as we're forecasting is going to happen in the next several years. And then they say, well, wait a minute, why were you buying back our stock at super high prices? And now when they've gone down 70, 80%, wouldn't this be a great time to buy our stocks? Oops, but you don't have any money left. You blew it in the boom. And don't we need all that cash to survive the greatest shakeout in history, like happened in the 1930s and other shakeout periods in time? So this is going to look really, really stupid. But it's the natural thing to do with markets on crack, with quantitative easing, taking over free market systems and saying, look, money's free, so whatever, do whatever, borrow more, buy back your own stock. Governments around the world are issuing record bonds and debt and then buying their own debt with money created out of thin air. So governments are buying their own debt. They're issuing. Companies are buying their own stocks. This is an artificial bubble. The 90s was a real bubble exaggerated by animal spirits and people getting too optimistic and jumping on and ignoring the fundamentals and bidding up stocks to unrealistic levels. But they were betting on something real. This is not real. Demographics are slowing in the world. Productivity's been slowing for the last couple decades. All the fundamental trends are slowing. This is all bidding up stocks and financial assets, and that makes this bubble more dangerous than ever. So this is the new dumb money. Who would have thought top corporate executives, like for the S&P 500 and 100, buying back their own stocks? The more the market goes up, the lower interest rates and the easier money is, the more they buy into the top of a bubble at the highest prices in history, and will look like the greatest fools just years from now. And now add to all of this madness, we get the Trump tax cuts. $120 billion expected to be saved just in 2018 on these tax cuts. That's that much more cash flow, which companies are not investing in extra capacity, is we've tracked, and we did not expect them to substantially. That's money that goes to buying back their own stocks. Already in 2018, stock buybacks are expected to be close to $1 trillion, record levels. Now they're going to continue to be sustained by higher cash flow, 120 billion plus a year that corporations have gotten as a free gift from Uncle Sam in these tax cuts. So again, it's all about companies bidding up the market, buying their own stocks. That's the trend here. Another reason this bubble is going to burst, corporate bonds are at record levels of issuance in the United States and developed countries, and the emerging world took the free money created by the developed countries to save our banking systems in the 2008-9 crisis. That plentiful money they borrowed to catch up. They didn't borrow as much as we did into the 2007-2008 debt bubble. They borrowed since, and now the rising dollar and rising interest rates by the Fed and stuff, which is natural to happen, is hurting them, and the global economy slowing down. That's hurting them. So we're just going to have a huge corporate bubble burst in bonds, and that will be the trigger like subprime mortgage and real estate loans were 2007-8. This is going to burst anyway, but it's always nice to have a trigger. Corporate bonds are one of the big problems, and these executives are going to look like idiots for taking massive cash flow and buying their stocks at super overvalued levels and not having it when they really needed it in the great bust ahead. So look for that, and don't say we didn't warn you.